Many Americans believe they're on track for retirement, but the numbers tell a different story. The average 401k balance is just a little over $100,000, far below what most people actually need. Experts estimate that a comfortable retirement often requires more than $1 million. This gap happens because people rely on the plan but don't optimize it. Understanding how your 401k truly works is the first step to building real financial security. Free money, the employer match. One of the best benefits of a 401k is the employer match. This is literally free money your company gives you when you contribute. If your employer matches up to 6%, make sure you're contributing at least 6%. Otherwise, you're leaving money behind every single paycheck. Just remember, vesting rules matter. You may need to stay a few years before the employer's contributions fully belong to you. The worst move when changing jobs. Millions of Americans cash out their 401k when they switch jobs. This is one of the biggest financial mistakes you can make. A cash out means taxes, penalties, and losing years of compound growth. The right move is simple: do a direct rollover into an IRA or your new employer's 401k. It's quick, tax-free, and keeps your money growing. Raise your pay? Raise your contributions. Most employees increase their contributions only when their salary goes up. But they rarely increase them enough. If you get a $3,000 raise and your contribution increases by only $200 per year, you're missing a huge opportunity. Increase the percentage you contribute, not just the dollar amount. Your lifestyle won't feel it, but your retirement account certainly will. Ignoring investment performance. Many people set their 401k investments once and never look again. But funds can underperform the market by a wide margin. The U.S. stock market historically returns about 10% a year. If your fund is only returning 5 to 6%, you're losing hundreds of thousands over your career. Review your 401k performance at least once or twice a year. Small adjustments can lead to massive long-term gains. Too much company stock, a dangerous bet. Some employees buy a lot of their own company's stock. Sometimes at a discount, which looks like a deal. But putting too much of your retirement into one company is extremely risky. If the company struggles, you could lose your job and your savings at the same time. Keep individual stocks under 20% of your total portfolio. The downsides of 401ks and why you need an IRA too. A 401k is good, but it isn't perfect. The investment options are limited. Fees are often higher than what you'd pay in an IRA. That's why many Americans use both a 401k and a Roth IRA. It gives you more flexibility, more control, and better tax planning. Tax diversification matters. Whether you pay taxes now or later changes everything. Cashing out early, the ultimate disaster. Using your 401k to buy a car, pay off bills, or make big purchases seems convenient. But it can destroy your long-term wealth. You'll pay penalties and income taxes, and you'll lose decades of compound interest. Build a real emergency fund so you never have to touch your retirement money. The goal is $11,000 per month in dividends. Now let's switch gears and talk about dividend income. Earning $11,000 per month in dividends sounds incredible. It may not mean full retirement right away, but it creates serious financial freedom. Once your investments start generating that much income automatically, you become more motivated than ever to grow your portfolio. Choosing a dividend yield, avoid the high-yield trap. New investors often chase extremely high dividend yields. They see a stock paying 10% or 12% and think it's a shortcut to wealth. But high yields often mean high risk. The stock may be declining, the dividend may be unsafe, or the company may be struggling. A safe, realistic range for long-term investing is 0.5% to 5%. Stability matters more than the biggest yield. Examples: dividend, growth, and balanced options. If you want stability, a dividend ETF like SCHD is a great choice. A 3% yield means you'd need about $400,000 invested for $1,000 per month. If you want maximum long-term growth, funds like VUG focus on companies such as Apple and Microsoft. Low dividends, but strong appreciation. A balanced approach is the S&P 500 through funds like VOO, steady income and steady growth. Sector funds and individual high-yield stocks can pay more, but the risks increase sharply. How much you need to earn $11,000 per month? The math depends on the yield you choose. At 3%, you need roughly $4 per million. At 5%, about $2.6 million. At 8%, around $1.6 million. Higher yields mean less capital, but much higher risk. Your goal is to strike a balance between reliability and return. The best strategy for younger investors. If you're in your 20s, 30s, or even early 40s, focus on growth. Dividend income doesn't matter much early on. What matters is maximizing long-term returns. Even 1 to 2% higher annual growth can change your entire financial future. Later, as retirement gets closer, shift to dividend safety and capital preservation. Use the right strategy for the right stage of life. Final thoughts: your future is built today. Your retirement isn't determined by luck. It's shaped by the decisions you make today. Avoid the common 401k mistakes. Invest consistently. Balance growth with income. And remember, time is the most powerful tool you have. Start now, and your future self will thank you. Thanks for watching. Subscribe. More videos on investing every day.